Just one more. Okay, so everyone, this is Finance Meets Real Estate. So we meet here every Tuesday, 6:30 p.m. Eastern Standard Time. We have amazing guests. We've had like over 100 guests here so far. So Badri, he has been actually one of our early guests back, I believe around 2 years ago when he joined us here. And so he's the founder of Investor. So Investor is a platform for sponsors and investors essentially to invest in syndication deals like funds and so forth. And so today he's going to talk about customizable funds. It's an incredibly interesting concept. He'll discuss the benefits of customizable funds for sponsors and investors. So they combine the features of syndications and funds, giving investors the ability to pick and choose deals and still get the benefits of a fund. And sponsors have also immense flexibility in their business model. They get legal, accounting, compliance, cost savings over doing a single syndication at a time. Okay, so Badri, so he has very extensive technology experience. So he co-founded 2 startups, extensive management experience as well, leading large teams at Fortune 500 companies. He has an MBA in marketing and finance and a master's in computer science. So it's going to be a very, very interesting lecture. So if you guys have any questions, feel free to put them in the chat, or you can raise your hand as well. But we'll do a presentation and then we'll open up for Q&A at the end. So with that, Badri, I'm passing on to you. And yeah, the floor is yours.
Hey, thanks a lot, Stefan. Good evening, everyone. I guess it is evening, I guess, in any part of the US now. So great to be back here in this group. I see some familiar faces. I think I know many of you, but not all of you. Let me go ahead and share my screen. I appreciate it. So the title is slightly different from what we had said, but it's still effectively the role of customizable funds, both for investors and but I really want to talk about what is the best tool to invest, not for both capital raising and for investments as we move towards a recession, and frame customizable funds in the context of that. And then, so there are kind of 3 parts to this. So the first part is this, and the second part, we'll talk a little bit about Investor and how a customizable fund works. And then the third part is we can take a look at what are some of the benefits of a customizable fund for investors, So it'll help if you put in the chat window if you're predominantly interested from a passive investor perspective or you're more interested in a sponsor perspective. But looking at the list of the people, I'm thinking there are more sponsors here. So let me start with that. Yeah. So very quickly, little note about myself. Like Stefan said, I've been in multiple startups. I love traveling. I'm from Portland, Oregon. I'm a Duck fan. They're doing okay this year. They didn't make the Pac-10, but that's okay. And my goal is to visit every country in the world. I used to run an option hedge fund trading company. I love hiking, skiing, and just some pictures of my family. I like to start with something personal before we get into all the nitty-gritty, right? So the question one has to ask yourself is, we are all talking about an impending recession. And what are all the different capital raising options? When I say capital raising, this also definitely applies to investors too, because they have to ultimately invest in one of these kind of options which you have to invest in, right? So it applies to both sponsors and investors. So you can do syndications, you can do SPVs, you can do funds, you can do fund of funds. And then I want to kind of focus on something new we are bringing to the marketplace called a customizable fund. So basically, let's first talk about how investors behave during a recession, right? So investors during a recession, they are seeking safer investments. And they want to increase their passive income. Several familiar faces here. Hi, Rick. He just launched this customizable fund. So I guess he knows all about this. Maybe he'll jump in and tell, hey, this is not correct or something, So they want to increase their passive income. They may not be sure about their job or, I guess there are a lot of layoffs. They seek out trusted advisors and they're really scared to make large single investments. I don't know, for the investors out there, how many of you really feel comfortable plopping $50 or $100,000 in a syndication deal, right? They want more diversification and they want a portfolio with multiple liquidity points, and they become a lot more sensitive to expenses. They want efficient investment vehicles, right? I mean, all this is like motherhood and apple pie. So if you look at the different choices of not only way you invest, but the way you capital raise for your investments, right? So the x-axis is the number of deals. Hey, I was an engineer in a prior life, so I have to generate this to a simple graph, right? So, and then the y-axis is the ownership. And so in a syndication, generally, the syndication owns the real estate. And similarly, the fund owns the real estate, but syndication owns a single piece of real estate and a fund owns multiple pieces of real estate. And an SPV is an entity which, a special purpose vehicle, is an entity which is created to invest in real estate. They don't normally own the real estate. And a fund of funds invests in multiple pieces of real estate, and it may also own the real estate. So let's get the terminology sorted out first. Fund, SPV, fund of funds, syndication. Some of you may have used some other terms interchangeably, but let's stick to this terminology, right? So what are some of the advantages of each structure for capital raisers and sponsors out there? All of you are familiar with syndications, simplest concept. You have full control of the asset. Risk is limited to the asset. You can do co-GPs, fast to execute. An SPV is a lower cost to set up. Again, the risk is limited to the asset. But if you look at a fund, it can own multiple assets. And again, you do own complete control of the assets. And the fundraising is separate from the asset itself, and you can raise money on a continuous basis. And in terms of fund of funds, it's again in multiple assets. You can diversify risk. And the point of a fund of funds is you can do both passive and active investments. Yeah. I'm going to go relatively fast because I want to focus a little more on customizable funds, but I want to kind of give the background for this. What are some of the disadvantages of each structure? In a syndication, you're under real time pressure. You have a very short rise time, and syndications are not a very scalable model. Can you imagine doing 5 syndications a year or 4 syndications a year, and in 5 years you have 20 syndications, 20 LLCs? It really is not very scalable. And when you're co-GPing with another syndicator, regardless of what the other platforms say, the main GP has complete access to your investors, because when accounting time comes, they will issue K1s and they have complete access to their investors. Some of the same disadvantages with an SPV. And in terms of a fund, there is very little transparency though. You're in a blind pool fund, you're investing in all the assets. Investors don't really have a control. And some of the same disadvantages are there in a fund of funds too. A traditional blind pool fund of funds, you cannot pick and choose which asset you want. And it's like a blind mutual fund, and you have to invest in every single asset. So we believe that funds are a much better vehicle, and customizable funds are even better vehicle to invest during a recession. It's not only a better vehicle for investors, it's also a better vehicle for sponsors. Why? Here are some of the important points. Sponsor has a lot more flexibility to raise capital. You're not tied to a deal timeline, right? So and investors feel a lot more comfortable spreading risk across multiple assets. If times are not well, you'd rather take $100,000 and put it in 10 different deals than put it all in one deal. And funds allow you to become more of the advisor kind of a relationship. It allows you to maintain more of an advisor kind of a relationship with your investors, where you're not selling them one deal at a time, and you're really making more of a portfolio. You're taking a portfolio approach and say, okay, let's look at all your investments, and you want more cash flow. Okay, you can invest more in debt notes, or you can invest more in value add deals. And some of the other reasons why funds are better during a recession is, even if a deal falls through, the capital is still available for another deal. You've already raised the money for the fund, and you have the flexibility to create a combination of passive income and long-term capital gains. Yeah. So what are customizable funds? So customizable funds really combine the best features of traditional funds and syndications. You have one set of legal documents like a traditional fund. You can raise money continuously like a traditional fund, and earnings can be reinvested. For example, we have funds in our platform where people put $5,000 or $10,000 regularly, and then they get to think of it like a stock brokerage account in a customizable fund where you can invest periodically and then decide to pick and choose which deals you want and how much you want to invest. They also have all the advantages of a syndication deal because investors can pick and choose which deal they want. There is complete deal level transparency. You get all the depreciation benefits which flow through just like a syndication. It flows through in a customizable fund. And in top of combining all the advantages of a traditional fund and a syndication, customizable funds have the ultimate business model flexibility, right? Because today, the problem with the blind pool fund is you need to have a very well-defined and a rigid business model. It could be investing in 100 to 400 units, which are multifamily units in the Sunbelt. So, or it could be I'm investing in small storage, storage deals in the Midwest. You cannot dynamically change because your investors will not be happy with you if you suddenly go off in a new asset class because they signed up to be in a particular asset class and they don't want you to suddenly switch. Yeah. Whereas in a customizable fund, since they're investing one deal at a time, you have massive business model flexibility. You can say, hey, today I'm doing a storage deal. Tomorrow I want to get into multifamily. The first investors are not going to get annoyed because they can always decide if they want to invest in a deal or not. And customizable funds by far the lowest cost option than doing multiple syndications. Once you factor in the cost of the legal, the cost of accounting, the cost of taxes, and so on. So any questions about customizable funds? And then I want to talk a little bit about Avestor and how Avestor can help you create a customizable fund.
I have a question. So, I mean, what essentially like you guys, and I know we've spoken before, like about your really nice product that you guys have in terms of customizable funds. And so what were some challenges or like, how did you guys go about creating this legally, if you will? And, like why it wasn't already common and existent, like in terms of other blanket funds, to your point, like if you just create a blanket fund, what is the challenge to getting all the segmentation to be able to do target deal by deal investment within that blanket fund? Good
question, Stefan. So it's always difficult to answer if this has all these advantages, why has somebody else not thought of it, right? I mean, it's hard to say. It is fairly complex to implement. We have spent literally tens of man years of effort sorting out the accounting issues, combining K1s, because one of the big advantages of what we provide is a single K1. So when you provide a single K1, what you have to do is you have to slice all the data from the different K1s and then combine it. And the accounting for a customizable fund is very, very different from a blind pool fund. So that might be part of the reason why nobody has implemented it. But we believe this will completely change the landscape of the capital raising industry. So.
Mm-hmm. Yeah. Okay, great answer.
Other questions, folks?
Yes, I'm curious if when you're doing the funds, I mean, typically, say we're talking about apartment syndications, you either have a 506B or a 506C offering. Is the customizable funds or any of the other funds set up where, it has to be, follow those same guidelines, like for people to invest in that fund? Like if you want non-accredited and accredited investors?
Excellent question. And in fact, this kind of also touches upon what is the legal structure. So when we built the customizable fund, we didn't really want to break new legal ground, okay? We wanted to ensure that we are sticking into the existing infrastructure So let me go ahead and I'm going to show one other slide, which may explain how the customizable fund works from a legal perspective. So what we would do is we would create a customizable fund LLC and a management LLC. And this customizable fund is very much under the Reg D framework. So it could either be I'm kind of getting to your question, Sonia. It could either be a 506B fund or a 506C fund. So all the limitations of the 506B fund and the 506C deals apply here. So a 506B deal, a fund, can have only 35 non-accredited investors, and the rest have to be accredited, but it cannot be advertised. And a 506C fund can be advertised, but it cannot take any non-accredited investors. But going back to this, so as part of the onboarding process, we would create the operating agreement, the fund PPM, and everything else. And then we would create a management LLC for you where different managers are there. And when investors come in, they come in at the fund LLC level, but then this fund could either own an asset or be an LP investor or a co-GP investor in an asset. And then what we would do is basically, let's say investor A comes in here and say they want to put $10,000 here, $20,000 here. And then we calculate what percentage of this LLC they would end up owning. So even though the customizable fund LLC owns these investments, if based on the calculation, we may end up calculating that investor A will own 0.56% of the LLC. So we are not breaking new legal ground. We are trying to stick to the Reg D framework. We don't want to go through the SEC approval process for a completely new kind of structure. But within the Reg D infrastructure, 506B and or 506C, we have innovated and solved some unique problems with software. So, did that answer your question, Sonia?
Mm-hmm. Yes, I was just curious. And is there any, I know you said for the 506B, you can have 35 non-accredited and then the rest have to be accredited. Is there a cap on how many can be in that fund?
A good question. Excellent question, in fact. So there are various exemptions you can take. It depends on whether you are investing in other people's deals or they're your own deals. So there is a distinction. If you're doing your own real estate deals, then you would take, if you're not doing your own real estate deals, you take the 3C1 exemption, which does limit the number of investors to 100 investors. But if you're doing your own deals, then you would take the 3C5 exemption. If you do a 3C5 exemption, 80% of the investments have to be real estate you're directly controlling. And so the fund LLC has to control that real estate. So it would be more of this kind of a scenario. The fund would own 100% of a real estate asset and 100% of the distributions would come in. In that case, there is no limit to the number of investors. Sorry, it is a more complex answer to your question. So it depends on whether you're doing your own deals or you're raising capital for others.
Okay. And what was that other one called again? I'm sorry. If it was your own deal, a 3.
If it is your own deal, it's a 3C5 exemption. But if you're raising money for others, where you're just investing as in a co-GP kind of a model, that's a 3C1 exemption.
Okay.
Okay. So let me go ahead and quickly talk a little bit about Investor, and then we can continue, go back, Investor and customizable funds. Unfortunately, they're a little interchangeable because so far, we hope that'll change, and we hope more customizable funds will become completely prevalent. But so far, Investor is the only platform which provides customizable funds. So Investor is a one-of-a-kind platform which brings together investors and sponsors with this new type of fund called a customizable fund, which combines the best features of syndications and funds. So the way it works is you form a single fund to house all your deals. Instead of creating one syndication at a time, you create this evergreen customizable fund, which is like a foundation. You can add any number of deals over time, and your investors choose which deals they want. Yeah. And you can raise capital 365 days a year. You can literally add any asset class in a single fund. And the nice thing is you're still getting all the benefits of the syndication, right? You can customize returns and promotes by deal. So the interesting thing about this model is there is no notion of a fund level return. It's all a consolidation of a deal. That's like me coming and asking, hey, Stefan, what's the return of your standard stock portfolio? Well, he'll say, well, it depends on what stocks are in the portfolio, right? So similarly, there is no fund level return. There is only deal level return, and you can still have different deals and different returns in each deal. And you have the flexibility to be a GP where you own your own deals and do your own real estate, a co-GP where you basically are capital raising for others, or you can be an LP on the deal itself. So you can even, the fund can invest as an LP in another deal where you're not getting any co-GP stake. And the way you make money is in the fund management revenue. Sure, you're not going to make as much money as in a GP or a co-GP deal, but what you're doing now is you're building a holistic relationship. I go back to my earlier slides, and you're offering a continuous stream of deals to your investors, as opposed to just saying you're popping in every 9 months and say, here is a new deal which I have. Yep. So an important distinction, I want you to be aware that don't think of us as a software platform. We do have a nice software platform, but that's just one element of what we offer. We are very different from the other software platforms out there because we offer an end-to-end offering. We consult with you on fund strategy. We help you with the legal and regulatory stuff of setting up the customizable fund. We help you with investment management, investor management, compliance, and accounting and taxes. So basically, when you work with an investor, you get access. We help you set up the fund, and you have complete access to our partner network, legal, marketing, accounting. We help you set up the legal entities, 1 ppm per fund, the subscription agreements. We help you with the Reg D and the Blue Sky filings. And in terms of the operations, we help you onboard the investors. If your investors want a small deal of a small slice of your deal, a fund like this is a great fit for during times of recession, right? This goes back to the elements which I said. I mean, if you want to invest in one deal and you want to put 100,000, people feel reluctant. Whereas a customizable fund, you can slice it and say, hey, you can put as little as $5,000 or $10,000 in a deal. So it's an advantage even both for the sponsors and for the investors. So you can still have a fund level minimum. You can say that I want to put, there is a minimum of $50,000 to get into the fund. But once you get into the fund, you can put as little as $10,000 per deal. Yeah. So we also do the accreditation, AML, and KYC checks. It's all integrated. And we help you with the financials and oversight, reconciliations, incomes, tax calculations. And I know I mentioned this before, but I can't stress how much our investors love the single K1. Even though they pick maybe 10 different deals and they're investing different amounts in different deals, they still get a single K1, which significantly reduces tax prep costs. Frankly, the only person happy getting 10 K1s at tax time is your accountant, maybe, right? Maybe even the accountant is not that happy. And there are some tax benefits as well with a single K1, yeah? And so to recap, it's a turnkey solution. All operations are handled, including the initial legal entity. It's an evergreen fund. Once you create it, you can add any number of deals. It's customizable, accommodates a wide range of investment products. It can have both GP and LP investments, completely streamlined in terms of KYC checks, operations, accounting, and reconciliations. And here is something a little interesting. We are the only platform in the world which will allow you to backfill your GP capital. What do I mean by that? Let's say some of you are doing your own deals, some of you are capital raising for others. Let's say you're raising $1 million, you're under 100K short or 200K short. You put your own money in or company's money in, and you can slice it and allocate it to investors 6 months later or even 1 year later. And we calculate the time value of money. Other platforms give you a portion of the cash distributions, but we actually give you a portion of the capital gains too. So let's say you allocate 10,000 of that 6 months later, and it's a 5-year deal. So you get 10% of the capital gains when the deal exits. So what this allows you to do is it allows you to move inventory capital from deal to deal and decouple closing a deal from raising all the money from the investors. So let me pause here. Wanted to talk to you a little bit about customizable funds. Wanted to talk to you a little bit about investor, and I want to make sure you understand the distinction between a customizable fund and a blind pool fund or a syndication deal. Questions, comments?
I have a question.
Sure. Hi, Rick.
I'm on board. I have a fund, an investor fund, so I'm on board. But I still have questions too, because I'm new at this. Do most of the fund managers on the investor platform raise like a traditional blind pool evergreen fund where they just bring the money, bring the capital on in, or do they get a commit and then pull it down when you actually have a deal that the investor wants to allocate it to?
It varies, right? People who have a higher fund level minimum do bring the money in first, say that, hey, to get into the fund, you do have to invest $50,000. But once you put the 50,000, then as the deals come in, you can get to choose how much you want to invest in. But having said that, a lot of the funds on the platform seem to have a lower deal level minimum, and they're just pulling money in as the deal comes. But it's really what your investors want and what model fits for you. So some do pull the money in for the fund level minimum, not the additional money. Once the fund level minimum gets allocated to multiple deals, then obviously you'll have to add additional money to invest in a new deal. It's like a stock brokerage account. You fund it with a certain amount, then you buy a bunch of stocks, you run out of money to buy stocks, and you add additional money to buy new stocks.
I just am concerned about, the cash drag, so if it's just sitting there not being used.
Yeah, so that's why you don't want to, absolutely valid concern. So if you do insist on a fund level minimum and they want to put 50,000 and your deal level minimum is lower, then either there are multiple things you can do. You could offer them a nominal interest rate, or you can work with other fund managers in the investor platform or other outside and offer non-GP deals, right? I mean, you and I have talked about it, Rick. I sent you a deal too. So a couple of choices you can do. So, so you don't want to make the fund level minimum so much higher than the deal level minimum that there's a bunch of cash sitting in the account. I don't know if Rick is deep in thought or is just frozen. I would say he's frozen. Okay. So let's maybe we can have some interactive conversation. Oh, sorry, Rick, you're back. I thought you were deep in thought for a couple of minutes there.
I felt the same way. Yeah, all of a sudden you just froze up.
Yeah.
I also had, and I've got to run. I'm sorry. I wanted to support your presentation, but I need to run. But I do have one other question, because it seems like being able to slice these things and offering smaller deal slices, that's great from the investor's perspective. But if I give them 10,000 instead of 100,000, then I have to have 10 times as many investors. So there is that disadvantage.
Fair point. But what we are finding is once a person puts 100,000, it's very tough to get $100,000 investor in times of recession like this, or where times are not booming. We find that the investors are a lot more, they ask less questions about a deal. They're a lot more flexible, and the numbers you'll have to work around, right? Maybe 10 is too low. Maybe you put 20 or a 25 minimum per deal, but a 50 or 100 minimum per fund. So two things we find. We find that investors ask a lot less questions when they're investing in a smaller deal, and they're willing to add additional amount rapidly, as opposed to investing in one deal and then going away for multiple years. So,
one final question.
Sure.
Since there's no fund level returns, does your system can it calculate what the average return of the deals that you would have, like in my fund?
Yes, it absolutely does. It shows the total return on all the deals and on the deals which have exited. You and I can talk more offline, and I can give a demo.
Yeah, and for people watching, I'm still learning about the investor platform. I'm just in the middle of
he's in the middle of launching his fund.
Final stage, yeah. So that's why I wanted to be here. I always learn everywhere I go. So anyway, thank you very much. I got to take off, but I appreciate it. And thank you, Stefan, for having Badri on and goodbye, everybody else. See you, Trevor. Take care. Okay, bye.
Thanks, Rick. So are people here mostly doing syndications? Or I know Trevor does syndications, and how about the others? Are there more passive investors here? What's the general mix here?
I think we have some people of both types, basically. So I think we have both. I think kind of people doing different things. Pretty even, I would say.
I see. And I also recognize Jay. We just had a call all of 3-4 hours back, and she's in the process of creating a fund too, Jay Miller. So,
So Badri, I guess or actually, am I interrupting someone? I'm not sure.
Oh, I was just going to say, just to clarify. So if you have, say, the fund, you can only invest in a syndication or co-GP. Like say, I have a fund that I want to do the both accredited, non-accredited investors. I can only invest as a, say, co-GP or GP or even an LP with that same syndication type.
No, not at all. You can do your own deals too. You don't have to invest in other syndication deals. If you put the entire fund in the platform, entire asset, so this would be a structure like this, right? The fund would own 100% of an asset LLC, and it could be as little as you can kind of effectively do syndications on a duplex, which is just not possible with a regular syndication, right? Because the overhead is too much. So it could be a structure like this where you own an asset, and then there are multiple investors, or it could be a structure like this where you're just making an investment in another asset, which is either syndicated or it need not be syndicated. It could be a joint venture kind of an arrangement too. So this does not have to be syndicated. For example, I know I'm probably going in a little bit in the weeds here, but you could have other LLCs come in here at the asset LLC level. So this doesn't have to be syndicated. Did I answer your question, or did I confuse you more?
Yes, kind of. I was just, curious if there was a way around, like, say I'm an accredited investor and I put a fund together, but I want to put a fund that would have a mixture of both accredited and non-accredited, right? So if an opportunity come up to invest in a deal, but it was a 506c offering, even though I'm accredited and say I'm the fund manager, but I have, a mixture of non-accredited and accredited, I probably couldn't invest in that deal as a fund because it's not like.
Now I understand your question. So here are some rules. We are getting into a little more detail, but I'm happy to get into that. So a 506B fund, there are two types of funds, a 506B fund or a 506C fund. A 506B fund can invest only in 506B deals until it hits $5 million. Once it hits $5 million, the 506B fund itself becomes accredited and it can invest in 506C deals. But whereas a 506C fund can invest in both 506B and 506C deals, and a 506B fund cannot be advertised and a 506C fund can be advertised. That's the trade-off. So if you do have a mixture of non-accredited and accredited investors, the best strategy would be for you to try to get to $5 million as soon as possible in your fund, and then the fund itself becomes accredited. And you can invest in 506C deals as well and expose them to non-accredited investors.
Okay, thank you.
Happy to chat more offline. So.
So
other questions, or would people like a quick demo based on, I mean, I'm willing to go wherever people want to go. So.
Sure, yeah. If you want, let's do the demo about Badri,
Okay.
and then we can take a few more questions. Yeah.
All right, sounds good.
Yeah, that's great.
So when you create a fund on the platform, you get access to your own branded portal, just like any other portal. And then you would, I mean, obviously, I hope you won't call it the demo fund, but this is just an example. And then you would log in. The best way to think of this, I know I've used this analogy, but I'll repeat it, is think of it like a stock brokerage account for your investments for your investors. So they'll log in, they'll see the total account balance, they will see the number of deals which you have, which they've invested in. I wish Rick was here, but he's not here. This shows the average return on all the deals which have exited and the total earnings so far. And this is kind of a breakdown between the different asset classes. So here is something cool. This goes back to the relationship question, which I talked about, right? What type of relationship do you want to build with your investors? You want to build kind of a holistic portfolio relationship. And just like how an investment advisor would say, hey, you want to build 80% stocks, 20% bonds, you can replicate that with this fund. You can offer debt. It could be either your own debt, or you can offer, we recommend platforms where you can buy debt, and you can offer slices of debt. And this is, so you can replicate the stock bond experience for your investors. And this is, for lack of a better word, a vanity map which shows you how your deals are distributed across the country. You can click on anything to get more information. And then you will see a liquidity graph which tells you approximately when you'll get your money back. Not guaranteed in real estate, of course. And then like a stock brokerage account, you'll be able to see how not just how the overall fund is doing, but how each individual deal is doing. So for example, this person has put $30,000 in this value-add apartment complex. He's got $600 back so far. You can click on this to get additional information about the deal. This is like other platforms out there. You can upload multiple pictures. You can upload any other PPM or anything else you want to upload to the platform. And when they want to invest in a deal, they'll simply go to the current opportunities page, and then they will see all the deals which are available in the fund. So for example, there is a storage deal. They can click on this to get more information. And then they say, hey, Stefan, allocate 10 or $20,000 for me into this deal. And we have this entire backend portal, which will allow you to onboard investors, manage investments. And the beauty of this is, today, how long does it take you to do a syndication deal? If you're doing a new deal, or if you're creating an SPV, multiple weeks. Whereas here, you can add a new deal within 45 minutes on the platform, and you can kind of experiment. Let's see, hey, how much interest there is in the deal. And if there is enough interest, you can go consolidate all the soft commits, and you can go invest in the deal. So you have more flexibility here because you can add deals dynamically within about half an hour or 45 minutes. So that's the basic idea. So the best analogy is, think of it like a stock brokerage account for your investors, for your investments.
Yeah, that's awesome. So, but in terms of, I have a question from the perspective of, again, like if the more traditional fund, like versus the customizable one that you guys have, which is, it's amazing in my view. But in terms of like in the more traditional fund, kind of you have a mandate, let's say, that you follow, that there's the fund level return, right? So that perspective, you spoke a bit with regards to the relationship with your investors, right? Sort of as an advisor of sort who kind of can guide them as to allocating into different things, right? But inherently, what is the reason for them to invest in your customizable fund compared to a traditional fund? Where a traditional fund, let's say they have a mandate of, to your point, let's say X units in these markets, opportunistic or core or value add, whichever strategy, and they kind of stick to that one consistent. But here, like the fund seems like more like kind of like the paperwork side it's incredible that's handled. So then it's like super easy for you to bring in like people for new deals and so forth. But what is the investment rationale? It's sort of for at the moment an investor puts money into your fund, it's sort of the sponsor reputation, sounds like, right? They just kind of perhaps the deals that are currently there, considering there's no mandate and considering there's no fund level return. So
what we are finding is investors like flexibility. I mean, blind pool funds force you to do a certain thing. I'm not saying customizable funds is necessarily a fit for everyone, but a vast majority of people we talk to like the flexibility of deciding which deal they want, what type of asset class they want to invest. And more importantly, a customizable fund gives you multiple points of liquidity. So if you invest in multiple deals, when a deal exits, you can take that money out. So you do not get that kind of liquidity in a blind pool fund where it is a 5-year fund, you wait until for 5 years to get your money back. Whereas here, you can invest some in short-term debt notes, some in equity, long-term equity deals, and it gives you multiple points of liquidity. So,
right. But so let's say from a sponsor perspective, say I want to start a customizable fund, right? And I have no deals in it. I'm not sure that's feasible, or I have just one deal, and then I kind of like decide I want to bring in some investors to my fund. Sounds like it's just that they want to invest with me as a reputation of a sponsor. And so they just kind of like putting funds under a person's name or a company's names, kind of, to then be distributed into the deals themselves. But there isn't another incentive, right? Like, I mean, how do we convince them at this initial stage, okay, you guys are investing in my fund, but what is your fund? It doesn't have a mandate, right? So it's going to be like all these different deals. It's going to be flexible for you guys. So what is the initial conversation you see like,
so it depends on what stage you are in when you create a fund. We have established fund operators who can say, hey, I'm creating a fund and I'll give you one deal at a time. Go ahead and give the money in. And we have seen them get the money. Or we have also people who are starting out. For them, they're not even mentioning the fund. They're just starting with, hey, here is a deal. Oh, by the way, when you invest in the deal, you're in a customizable fund and you get all these benefits. So we have some fund managers who are promoting the fund, and there are some fund managers who are promoting a deal, and as a more cost-efficient way of doing syndication deals. So ultimately, you're paying lower, and the amount of expenses is actually lower in a customizable fund than doing 10 different syndication deals. So investors are saving in those investment costs. And so we have both the type of fund managers. Some are promoting the fund itself, and some are just promoting the deal. And they just happen to say, hey, it happens to be in a customizable fund. So.
And so besides, like, so bringing their own investors, so your platform kind of, their people subscribe to your limited partner investors, we call it like passive investors, subscribe to your platform as well.
So one of the things we are doing is we do have a marketplace. Right. And when you create a fund on the platform, then you get exposure in the marketplace. And when investors come in, if they like your fund and the type of assets you're investing in and the deals, they can contact you. I mean, there is a contact manager option in the marketplace. That's one piece. And the second piece is, apart from investors, Avestor has its own mastermind. And you can basically interact with other fund managers. There are capital raisers looking for deals, and there are people who have their own deals who are looking for capital raisers. It's as we get more and more traction, that's becoming really powerful because then people can interact and say, hey, here is a deal, and how many of you are interested? Because every person in the mastermind already is a fund of funds manager. So it's very easy for them to say, okay, I'll raise $500,000 for this deal, and you can combine it, and you're getting the power of multiple fund managers working together. I think Andrew has a question.
Hey, Badri. Very interesting.
Hey, Andrew, how are you?
I'm doing great. Thank you. Can you expound on the marketplace a little bit? That's a very interesting concept. Is that from users on the platform, or is that something different? Maybe I'm mistaken.
So we have so let me show you a preliminary version of the marketplace. We are going to completely redefine our website, and we are in the process of branding this completely, rebranding Avestor and everything else. So if you go to Avestor, by the way, I'll put my contact information in the chat window if anybody wants to reach out. If you go to avestorinc.com, you can click on Marketplace. This is not a complete list of our funds. Obviously, we can't list 506B funds. And there are other funds which we just haven't had a chance to list because we are redesigning the website. So we will start funneling advertising dollars for people to come in here. Let's go ahead and pick a fund here. So this is a hard money lending fund. Some of you may know Bobby Sharma, and he started more than a year back, and he's almost at $11 or $12 million. And they can say, hey, I like this idea of first mortgage liens. It's offering 8 to 11%. I like this person's background. And then they can either join the fund, which is unlikely, without talking to the manager, or contact the manager. So our goal is for Avestor to become a one-stop shopping center, which will not only provide you investors. We are not quite there yet because we are doing a venture capital round in a couple of, in 2 or 3 quarters. And then we'll funnel a lot of advertising dollars. But already people are beginning to come to the marketplace, exploring and seeing what type of funds are there. 50 funds is a lot already, right, for alternative investments. And did I answer your question, Andrew?
You did. It was a little more of a complex question, but part of it, I think you answered in the fact that you guys will be bringing the eyes to the funds that we have available.
Exactly.
And the other part of it is that other sponsors that have their funds on your platform will see this as well. So it could become almost like a co-sponsor type relationship. Whereas if I'm looking for another asset class to add to my fund, I can reach out to a Bobby Sharma and say,
exactly,
hey, I like what you're doing.
Yeah, you don't have to go through the marketplace for that. We have masterminds and we have regular meetings every 2 weeks. And we have we have an internal Slack channel. It's almost like, like the other mastermind groups where we provide opportunities for you to interact with other, that's exactly what is already happening. We have some great self-storage operators who are basically offering deals, and a lot of the other operators are putting that in their fund. So.
Okay, not to take time for anyone else, but I am curious, is there an additional cost associated with that, or is that included?
No, see, we have built a model where we don't want to nickel and dime. I mean, it's one flat fee, the mastermind is included. What the power of the Avestor platform is, as we become bigger and bigger and more fund managers join, we get negotiating. I don't know if it's a good analogy. We become like the Costco model, right? We can go to an accountant and we can negotiate discounted rates, and we already have. We work with top 20 accounting companies who will do fund accounting for a much lower cost than what you would get if you go directly to them. And so it's not just, I guess the point I'm trying to make is you don't have to come here and browse through the marketplace. We actively facilitate connections, and we also actively negotiate with vendors to give highly preferred terms to fund managers on the platform.
Excellent. Thank you, Badri.
Sure. I think Jay has a question.
Yes, I do. Can you hear me?
Yes.
Sorry, I've got another screen going, but I'm totally focused on listening to this. It's good to know the things I haven't learned so far, but I'm guessing that each individual investor gets their, of course, they get their own username and password, and they can see the actual performance of what they have chosen to invest in personally themselves.
Exactly. Just like a stock brokerage account, not only will they see the overall performance of the account, you put 100,000 and it's become 130,000, you made 30% even numbers. But yeah, in that 100,000, you put the 100,000 in 10 different investments. How did each investment do? It's all about transparency. I know there are some investors in the call. A customizable fund provides you transparency. It provides you liquidity because there are multiple smaller pieces you're investing in. And it provides you tax efficiency because of a single K1. Speaking to the investors.
Great to know. Now, the other thing I want to know is when there's, let's say you have several verticals in a 506B, for example, and you're there, and then you can, as you grow, you can branch out into the larger benefits of your platform. But let's say you have several verticals and you're operating as a 506B, does it show the individual? Can we choose showing the performance of each vertical that they have not yet invested in? Because I don't want to create a competition between, if we're doing multiple deals within a 506B, because every vertical is has its own type of client, has its own type of investor, and how much one performs against the other isn't even relevant. But some people are going to want to see, oh, a lot of people investing in this, it must be good. But it's really, you can't really compare them.
That's part of the investor education, right? I mean, it's all about building multiple diversified portfolios across multiple asset classes within real estate or non-real estate and multiple geographies. So I would classify that more as an investor education thing, where you have to tell them, just because this is offering higher returns, you don't put 100% of your money in that, right? I mean, so it's all about building a holistic relationship with your investor and understanding their needs. Some people are earlier on in their journey. Some people are closer to retirement, where a value add or a debt deal might be more appropriate than a risky new construction deal. So,
yeah. So my question is, if you've got like several verticals in a 506B and only your investors can see that, but can we control how much, without naming names, of course, just not keeping score about who's investing in what?
You mean, will other investors see how will investor A see what investor B has done? Is that your question?
Or just like numbers, as opposed to how many investors or how much money has been put in any one particular vertical? Can we control that?
Yeah, the investors are not going to see that. Only you will see that as a fund manager.
Okay, great. Because I was afraid that the
investors are not going to say anything about how much people have put in the other deals. No.
All right, great. I didn't want to take that for granted, and I felt like I needed to ask. It's good to know.
Good question. Sorry, now I understand what you're asking.
Yeah, thanks.
So let me go ahead and put my information in the chat window, but happy to take more questions. Any other questions?
Yes, so Sonia actually asked, does the fund stay open indefinitely?
Sorry, I missed that. I've been missing the chat window. So
no worries. Yeah.
Yes, the fund is open indefinitely until you get tired and decide to close the fund. So there is no legal restriction. I mean, typically we put 10 years, but we can extend it if needed. So.
And now, is it like in terms of pricing, let's say, like, is it something you guys can share like over here, or do you want like people to kind of reach back to you afterwards? Like,
no, I can give you a rough pricing, but I don't want to get into the details because it's better. I mean, I can give you a high level detail too, but it's just that maybe the others are not interested. It costs roughly about $15,000 to get started. Our prices are going up from the beginning of the year. It'll go up to about 18 or 19. But that is roughly what you pay for one syndication deal. And then we do have a platform fee, which is tied to assets under management. So we charge anywhere from 0.3 to 0.5%. But like I said, we even have a calculator which shows you that you're actually saving money even if you do 2 syndication deals a year, versus doing a customizable fund. So
understood, got it. So yeah, that's clear. Thanks for that.
And let me go ahead and I'll give you my complete contact information. So my email, phone number, I'll put that in the chat window. Feel free to reach out. Even if you're not interested in creating a customizable fund, that's okay. But if you just want to talk, and happy to chat. So.
Great.
Any other questions?
Yeah, thanks for that. So I'm just going to share your website only. So investorinc.com.
Yeah.
Okay? Sounds good.
It's ABESTORINC.com. And I put all my information in the chat window. Yeah.
Sounds great. And okay, so any last questions? Anyone, like before we have like a few minutes, we're pretty much at our time. So it's been a great discussion so far.
Okay, I think the group is ready to wind down and move on to other things.
Right. So thanks, Badri. It was really,
Stefan. I appreciate the opportunity.
Yeah, no, I appreciate like having you here. So it's a great value I think you guys are providing to the industry for sure. So thanks for that.
Thank you. And thanks, Jay, for the confetti and the claps. She's playing with icons here.
Yep. Yep. Awesome. Thanks so much.
Yeah, thank you, everyone. And feel free to reach out if you have any questions. Take care.
Yeah, have a good night.
Bye-bye.